Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Rabbi shrah sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Very good morning, dear sisters and brothers. Before I start, I want to call you one by one to ensure that you are in the meeting now. Could you mention your name? I will just take your attendance. Fitra, Ahmad Fitra Vandana, are you there?
Yes, sir.
Okay, thank you, Fitra Vandana. Andrea?
Yes, sir.
Okay, baik.
Yes, sir.
Okay, Cika Malahayati.
Yes, sir.
Okay, Cika. Dini Meditya Kastuti. Dini, not there. Okay, Irin.
Yes,
Sister Irin. Okay, thank you. Karunisa Fadia Nadayu.
Yes, sir.
Okay, Licia Indrayana.
Yes, sir.
Okay, Indrayana. Lutfi Faris.
Yes, sir.
Okay, Nadila Ardina Husna Daulay.
Yes, sir.
Noni Pradika Sari.
Yes,
Noni.
sir.
Okay,
Yes, sir.
Rahmawati.
Yes, sir.
Raisa.
Yes, sir.
Rizky Novia.
Yes, sir.
Sigit Purnomo Aji.
Yes, sir.
Windy Fitriani.
Yes, sir.
Safira Liviani.
Yes, sir.
Okay. Except Dini, not mentioning. Okay. We have.
I'm sorry, bad connection.
Okay, this is matter. Okay, thank you. Okay, dear sisters and brothers, we have been in the sixth meeting right now, and almost going to seventh meeting. And by the way, we have not got any test competency at all since beginning. So next week, I have planned to arrange test competency 1 for you, whereby the material content since the first meeting until the fourth meeting. Yeah, so please do look at your my class. We try to make the test competency 1. The details will be informed you once you have in the test competency. Yeah, we will set in my class for the test competency. Okay, next week, please do prepare for the test competency 1, first meeting until fourth meeting. Okay, sisters and brothers, now I'm going to just carry on the discussion on financial banking management. And last week, I think you have learned and read chapter 5 in the textbook about the framework of risk management. Okay, before we start, I want to just to listen from Ahmad Vandana, Fitra. What did you know, Fitra, about the framework of risk management according to the books? Fitra, please.
What, sir?
Yeah, I will ask you one by one. Last week, I guess that you have read the content of 5th chapter according to the textbook. The book tells you about the framework for risk management in Islamic banks. So what did you learn so far, and what did you understand from the chapter, Vandana?
I think for the framework of the Islamic bank, it showed to us about how the bank, either Islamic or conventional bank, try to reduce the risks for the customer.
Okay, what else, Mandana? Okay, sisters and brothers, I wish that you read the books, yeah. Otherwise, the discussion is not smoothly as we wish, yeah. Because the book has been set from beginning, and I have put some of material contents, video, and all in the my class. So hopefully you can study and learn about this contents, and hopefully every week you have prepared yourself, yeah, to read and understand the chapter of the books, because in test competency there is no any remedial test, yeah, for those who cannot pass the exams. So I will try to value and mark you objectively, so there is no any um, remedials, yeah, if your test is not good as it is. So please do prepare and study what the tests and the material content that I have prepared in my class. Okay, doesn't matter, because I guess that all of you not yet well prepared about this course. I just want to tell you about the material contents that shown in the slides. Yeah. So I'm trying to combine between the chapter 5 and chapter 6. Yeah, because these two chapters are basically similar in terms of the how the Islamic Bank tries to mitigate and reduce the risk due to the operations that they have. And if you see from the, I'm trying here um, um, to summarize the content just into few slides. Yeah, hopefully you can get the idea, and then you can try to apply with the assignment that we set in my class. Okay, now we are going to discuss about the risk framework and balance sheet structures in Islamic banks, Islamic bankings. Yeah. So before we start, I just want to clarify about the Islamic banking and Islamic banks. Yeah, what is the difference? Yeah, so Islamic banking refers to the operational aspect of the banking sectors. So if we talk about banking, banking means the operational activities, lending, funding, services. So those are the coverage of the banking activities. So it may call us banking. But if you say about Islamic banks, yeah, it refers to the institutions, yeah, the institutions that conduct the banking activities. So my topic here, Islamic banking, means that we are refers to the activity that conducting by Islamic banks. And the risk framework here refers to the conditions where Islamic banking are actively engaging in the banking activity, so that they will expose to some risks due to the environment, dynamic environment, and also internal environments. Yeah. So if you read from some literatures, maybe you can get some idea of micro banking, yeah, and macro banking. Yeah. Micro banking refers to the internal banking, and macro banking refers to the environment where the bank lies. Yeah. And the second one, balance sheet structures. Yeah. I think that not only banking has a balance sheet, all of us have a balance sheet, including you and I, because as a human being, we also try to balance between the funding and lending, between income and spending. Yeah. So balance sheet structure here will affect to the soundness or the healthy of Islamic banking operations. So now we try to little bit discuss on these issues. Yeah, hopefully you can get the idea, and then you can apply with your daily activities, or you can maybe take some experience then if you in the future you're working in the banking institutions. This one, sisters and brothers, just few slides here, just 8 slides. Yeah, but this slide that I just make, yeah, to summarize the two chapters. Yeah. Dear sisters and brothers, if you see from the book, yeah, actually that risk cannot be avoided. Yeah. So the risk cannot be avoided, cannot be uh, overcome. It means that the banking cannot run away from the risk because of in banking sectors they are running with the complex operations. Therefore, if you remember, there are so many regulations coming in regulating Islamic bank. For example, microprudential regulations, macroprudential regulation that set by OJK and Bank Indonesia in order to ensure that the banking sectors is helped. Yeah. And these risks that occur in Islamic banks is mainly due to the financial risk. Yeah, financial risk. So if you talk about financial risk, you talk about credit risk, liquidity risk, event risk, business risk, and any risk. Yeah. So those risks happens due to the banking sectors are dealing with either internal or external sectors. Yeah. And because of the risk cannot be avoided by a single entities, including Islamic banks, so the risk management here is needed in order to reduce and prevent or mitigate. So the first term here is reduce. Reduce means the risk exists and you try to decrease the limit of the risk. Because if we talk about risk, actually risk is not generally harmful if manageable. If manageable. So if the term reduce here coming in because the risk has been excessive or beyond the limited, the tolerable limit that has been set by the management. So it has to be reduced. And the second one is prevent. Prevent is a little bit complex compared to the use. Prevent means that the risk is not yet happening, yeah, and the institution tries to make this risk do not have impact to these institutions. So before the risk coming, the institution has been taking some positions to prevent it. Yeah. So from these two terms, reduce and prevent, we will try to look at the steps. Yeah. So either you try to reduce or prevent the risk, unprecedented risk or precedented risk. You have to have 3 steps here that I have summarized from the books. The first is risk identifications. So every single entities, including you, maybe if you are the manager or you are the management of banks, you have to identify what is the potential risk happens in next couple of times. Yeah. Therefore, some Islamic bank or conventional bank here try to promote and develop some techniques. For example, early warning system. Yeah, early warning system techniques. So this technique tries to identify some risks, and then the institution will try to prevent or mitigate if the risk exists or before the risk exists. And here, for risk identification, somehow the management tries to set some financial ratios. Therefore, if you found some ratios in the banking statistic reports, such as CAR, yeah, NPF, ROA, ROA, so those ratios actually are used to risk identification as the leading indicators to identify the risk. And second one is risk target. So basically, sisters and brothers, this the second term actually is very important. You see that in the banking sectors, yeah, somehow you are targeted, yeah, by the top management to get certain amount of profits, isn't it? So banking sectors is a commercial basis, not social basis. But in other side, you have to aware as well about the risks, yeah, because in the banking operation, you will face two extreme sides. The first is profit. The second side is risk. And these two are zero-sum game somehow. Zero-sum game. So if you promote the risk, yeah, so the profit, yeah, will be following. But of course, the profit somehow is quite unpredictable, because the more risk, somehow somebody talk about the more returns, but this more returns is very unpredictable. Yeah, somehow can and somehow cannot. But in other ways, yeah, if you try to maintain the risk, it means that you are to prevent the risk. So the profit will not be there because you are stagnant. You can see here the contradictions. Yeah. So if you promote your risk, your return will be following, but not predictable somehow. Yeah. But if you don't take the risk, it means that you avoid the risk. Yeah. The profit will be there, but not high as the previous one. But here, the management somehow, they have to set the target. So this year, the target of the profit is this. So the risk will be like this. So in other words, in order to trace the risk target happens, the management will set the tolerable or acceptable risk levels. Yeah. So the risk still accepted, but in tolerable limits. So therefore, you will have the threshold, yeah, upper threshold and lower threshold. These threshold basically are tolerable or acceptance risk levels. And the technique somehow is used are stress testing techniques. Yeah, so it is quite advanced technique, yeah, about stress testing. So stress testing is used by the banking, commercial or Islamic bank to look at to what extent the risk has been propagated, yeah, in the Islamic banks. To what extent the risk has been expanded, and then whether it is harmful or still under tolerable limits. So stress testing techniques. And the second one is the risk evaluations. So once you have identified the risk and you have already have the target of the risk, and you evaluate the risk, whether this risk is recommended in terms of the sustainability in the future, or you have to set another risk target. So here, somehow, the top management of banking must follow the regulations. So regulation actually coming in, sisters and brothers, due to the evaluation that has been observed by the regulators. Because regulators wants to keep the banking sectors sound and remain health in the midst of turbulency. So in risk evaluations, the regulators will give the micro and macro prudential regulation. I think you have already known before in certain Bank of Indonesia, for example, they have already set these regulations, either micro and macro prudentials. Yeah. So all of these three, sisters and brothers, by the way, yeah, are hand in hand together, yeah, in order to set up the risk mitigation techniques. Yeah. So if you're working in a bank, you will find and join this kind of steps. Yeah. And the next one is about the risk characteristic now. Yeah, the next one. In Islamic banks, yeah, the two different things compared to the conventional banks. Yeah. What are the difference? So the difference is, yeah, the main difference is, yeah. So the first one is about contractual rule. This is the main difference, the first difference. Yeah. So in the risk of Islamic bank happens because of the contractual activities that had by Islamic banks. And here we have three main contractual rules: trustee, partnership, and principles. Trustee, yeah, refers to the activity, for example, wadi'ah. Wadi'ah at amanah, for example. So wadi'ah at amanah is the contractual of trustee between depositors and banks. Yeah. And the second one is partnership. Yeah. Musyarakah, mudarabah, yeah, here. And the third one is principles such as murabahah. So these three things have a different type of risk. For example, yeah, if you as depositors, sisters and brothers, and you deposited your fund in Islamic bank in the form of musyarakah, yeah, or mudarabah. So the risk would be is you will be entrusted by the bank with a certain amount of fund, yeah, because you are as a moderate, yeah, and this fund given by bank could be lost because of the loss of your business, yeah. So the bank will face the risk of partnership. The trustee here, yeah, the trustee here also could be in the form of risk, wadi'ah. For example, the fund, yeah, that given by you to the bank suddenly cannot be returned back because of the losses of the borrowers, yeah. So that the bank will face the deposited risk, yeah. And the principle here, for example, murabaha, yeah. So you take financing of cars or houses, yeah, and you cannot pay back the annual or monthly installment. So what happens? The bank will face the asset risk, yeah, because the house and the car will be back to the bank, and bank should sell back to others to get the payment, yeah. So this one is this thing that will create a risk in the Islamic banks. And the second one is the fund characteristic. Differently with the conventional banks, sisters and brothers, Islamic bank has very complex structures in terms of the funds. Generally, it has the same form of conventional, but in details, you can see the liability side of funding sources in Islamic bank, they have so many varieties. In conventional bank, only one, or maybe only three, yeah, deposit, yeah, giro, demand deposit, yeah, time deposit, and saving deposit. But in Islamic bank, we have demand deposit, investment account, special investment account, reserves, equity shareholders fund. So those funds are under the liability side. Why? Because those funds subjects to liability and must be back to the depositors. Yeah. And the asset side, in the right hand side here, yeah, we have the application of the sources. Yeah. And here, yeah, you can see that in the asset, in the context of conventional bank, you only has one activities, namely credit. But in Islamic bank, we have very tight contracts: cash, financing asset, investment in real estate, property ownership, and fee-based income. And those activities here are under special contracts or special akad. Yeah. So these two, sisters and brothers, are the main risks from Islamic banks, and it happens because of the operational activities, yeah, and the dynamic environments, yeah, they're coming into Islamic banks. This is the first slide. The second slide here. So now the question remains how to reduce or prevent the existing risks by looking at the balance sheet or the fund characteristic or the contractual rule Islamic banks. here I try to propose 3 models. Yeah. And these models are actually happening in existing banks. The first one, concept of pooling of funds. Yeah. The concept pooling of fund here, bank will pool all of the deposited fund regardless, yeah, regardless the type of the sources of fund. You can see here from the left hand side, we have giro, tabungan, deposito, saving, credit, yeah, financing, and capital. And all of these 5 will be pooled into one single account named pooling of fund account, regardless the tempo, the time of due date. Yeah. From here you can see the giro here is the shortest due date for the withdrawals. Tabungan is a little bit longer, and deposito is the longest in terms of the due dates. Yeah. Capitals, yeah, and here is the borrow, yeah, the credit coming from another institutions. Yeah. And once the bank has already pulled this one, will be distributed to all of these things, regardless the time here. So from this thing, sisters and brothers, you can see what happens if the bank only pulling of the fund, regardless the due date of this source of fund, the bank will face the liquidity problems. Why it happens? Because you see here in deposited fund, it has the tenor 1 month minimal and maximum maybe 2 years. Tabungan and giro, it has the shortest one, only 1 day, maybe 1 minute only, 2 minutes, 1 hour, 2 hours. But this one are channeled into this one. For example, the financing. The financing here, for example, takes 20 years, 10 years. So what happened then? So if the bank put here the money into the financing, and the money suddenly withdraw by the depositors, the money is still here, but the depositors withdraws the funds. What happens then? The bank will face liquidity problem. Yeah. So the bank will take the capital then in order to fulfill the obligation due to depositors' withdrawals. This is the first concept pooling of fund, regardless the tenure of the sources of fund. Yeah, here. And the second one, sisters, here is allocation of fund. This model actually try to allocate the source of fund into several financing. It is more complicated because the giro here, the demand deposit, is channeled into several financing here. So we do worry if this source of fund channel here in every financing sectors in here in right hand side, yeah. But suddenly the depositors withdraw the money here. So what happened will be here? The bank money still operationalized in the right hand side in here, yeah. But the customers withdraws the money. So the bank again will face liquidity problems because the bank did not spend it, yeah, the fund according to the due date or time period, yeah. The second models. And the third one, this is a good one, the conversion of fund. So in this regard, you see, sisters and brothers, the bank operate from the right hand side, not from the left hand side. The two previous approaches, they come from the left hand side, the left to the right. But here, from the right to the left. On this regard, the bank here has already separated the fund into 3 main tenors: short terms, medium terms, and long terms. And once the bank has already separated here, the financing also will be following the scheme that has been set here: short terms, medium terms, and long terms. So once the bank has already set the financing into three different tenors, so the bank then look for the potential funds that are considered under short, medium, and long, and the bank can obtain it. For example, here the short term through giro and savings. The medium terms from medium deposit, time deposit. The long term here from the long term deposit. So from this regard, if someday or suddenly the depositors withdraw the money, the bank can anticipate that and can handle the liquidity problem because of the financing that conducted by the bank also in the short terms. So in short term meet the short terms, medium term meet the medium terms, and long term meet long terms. So this scheme is actually the best one in order to ensure that the balance sheet of the bank remains sound. There is no any balance sheet problems because the crisis of the banking sectors comes from the balance sheet first. If the balance sheet cannot be manageable, so that it will affect to the operational activity of Islamic banks. And in the end, the bank will be vulnerable to crisis and then will fall into severe banking problems. Okay, sisters and brothers, this is the thing that I can share with you regarding with the risk framework, the risk framework and balance sheet structure of Islamic banks. So the conclusion is that the framework of the risk management in Islamic banks are related to the contract and sources of funds characteristic. So the risk of Islamic bank is based on this. And the second one, the growth of risk through balance sheet performance, must be reduced and prevented by prudential regulations. Therefore, the Bank Indonesia and OJK have conducted so many regulations in order to ensure that Islamic bank remain in the sound and controllable. And the third one, quantitative and qualitative approaches are needed to capture the growth of risk Islamic banks. So you maybe, if you're interested to learn about the risk, you can conduct some research on risk management, either in the area of risk identification or risk target or maybe risk evaluations. So those things are needed indeed, in order to make Islamic bank remain sound, stable, and robust in the midst of dynamic turbulence in this pandemic. Okay, sisters and brothers, I think that's all the one that I can share with you today. If you have some questions or maybe clarifications, are most welcome. Please. Any questions or you have any inquiries so far?
So far, not yet, sir.
Okay, I have a question then with you. Yeah, I
Sir?
have a questions. Yeah. Yes, again.
I still confused the difference between polling concept, polling of funds and allocation of funds, sir. What are the differences, sir?
Okay, before I answer your question, I will ask to everybody here first. Yeah. Because I want to ensure that you are following the discussions. Yeah. The first questions, Safira. Safira, are you there?
Yes, sir.
Okay, I want to ask you a questions. Yeah. What is the difference between the risk management in conventional banks and Islamic banks? Safira, can you answer directly, please? This thing that I worry from you, yeah. Okay, Windy. Windy, are you there, Windy?
Yes, sir.
Okay, can you answer my previous questions to Safira, please? What is the risk management in Islamic and conventional bank? What is the main difference? Can you just give us a short or brief response, please? Okay, no response. Lisa, please, Lisa.
I think it's the difference between Islamic bank and conventional bank. It's in its contract, sir.
Sorry, can you repeat again? What the last statement?
I think the difference on its contract.
What does it mean?
The difference between the Islamic and conventional bank differentiate on its contract, whether it's also different on its source of funds characteristic and the flow.
Okay. I will directly answer to the Sigit questions then. Yeah. Okay, Sigit, you asked about the difference within the approaches here. Yeah. So Sigit, if you see from this screen, by the way, the main difference is in terms of the whether Islamic banks separate or classify between the short, medium, and long term, either of the funding sources or financing sources. In the first concept, pooling of funds, there is no any separations. So the bank just channels, yeah, the short to the long to the short, yeah, the long to the medium, regardless the characteristic in the funding sides, yeah. And in the second approach, allocation of funds as well, there is no any separations. Short to long, long to short could be like that. But in the third here, the conversion of funds, you see that there are separations. the bank has already classified. Short meets the short, long meets the long, medium meets the medium. So what is the main aims of these three approaches? Basically is to manage the liquidity of the banks. Because you see banks, Islamic brothers, yeah, the bank has no money. The bank has money because of your deposited funds. And your deposit fund can be withdrawn whatever you want, except for time deposit. And the bank, for sure, once they have got the money from you, this money do not only stay in the bank because it will create costs unless the bank channel this money into financings. Yeah. But the problem remains if the bank channels into financing, yeah, the bank forgot somehow the sources characteristic of the funds. Whether the sources of fund has characteristic of the short, medium, or long. So the problem will be having when the deposited customers withdraw the money, but in other side, the money that he or she put in the bank is being channeled into financing, whereby maybe medium or long terms. So it will affect to the bank money, isn't it? The bank has no enough money, so the bank could do the two things if they has a liquidity problem. The first one, they can take the money from the capital side. And the second one, the bank look for additional debts or borrowing, yeah, from others institution, yeah, or maybe take the fund that put in central banks. So those things can be done in order to maintain the liquidity money in the bank accounts. That once you get that, I can answer from your question. Hopefully you can understand. Or maybe you have any comments, please.
Okay, sir. Thank you.
Any other questions or maybe comments, please?
Sir, I want to ask.
Yes, please.
Which one is riskier? Is it conventional banking or Islamic bank? And which one is more liquid?
Okay. In terms of the liquidity, yeah. If we talk about liquidity, it means we talk about instruments. Yeah, instrument of finance instruments. And in the banks, we recognize three instruments. The first, demand deposit atau giro. Second one is saving account. The third one is time deposit atau deposito. So these three things, yeah, are the account that will be put in Islamic bank or conventional banks. And characteristically, yeah, these three things has their own benefit and unbenefit. But in my humble understanding, yeah, between Islamic and conventional banks, the more liquid, yeah, not in terms of the bank types, but in terms of the instrument types. Whereby among these three things is time deposit. Time deposit. So either Islamic or conventional bank, they have this time deposit. But the main difference between Islamic and conventional banks, in terms of time deposit, in Islamic bank, we divide into two main time deposit. The first one is Mudarabah investment account limited. Yeah, so limited investment account. And the second one, unlimited investment account or restricted investment account or unrestricted investment account in Islamic banks. Yeah, but in conventional, they don't divide into these two things. Yeah, so that's the sisters. So the most liquid is the time deposit. Yeah, because time deposit has the time limits. The customers cannot withdraw the money if the tenure has not been passed, minimum 1 month until maximum 2 years. That's sisters.
Okay, sir. Thank you.
Okay, Lisa. Others, you have any other questions, please? Any other questions, please? Okay, if there's no questions, I think I can give you some exercises, yeah, in my class that I will assign you to look for some risk management techniques, yeah, between conventional Islamic banks, yeah. And the details, maybe I will put in my class, yeah, in order to equip you more deep understanding on balance sheet and risk framework. Okay, any other questions, sisters, brothers, please? The details you can open in my class. Yeah, I have put some, by the way, some videos there. Yeah, and also some materials, including the recorded video today. I will put inside the 6th meeting. Yeah, and don't forget, next week we will have test competency 1, covering from first meeting. You can see the first meeting until the 4th meeting. Yeah, until the 4th meeting. Yes, the 4th meeting. And the test competency will be started 9 EM until 11 PM West Indonesia time. So you can access within that periods, and you can submit the test competency within that period. Okay, that's all. I think, sisters and brothers, for a while, because you have no other discussion so far. So I wish that you understand, and we will see you next week, yeah, on test competency 1. If you have some question and if you have some inquiries, please don't hesitate to contact me. Okay, with all, we end these sessions. Yeah. Thank you very much for your very kind attention and cooperations. Inshallah, see you next week. With that, I end. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Waalaikumsalam
Waalaikumsalam
warahmatullahi wabarakatuh. Thank you,
Thank
sir.
you.
Thank you, sir.
Thank you, sir.